Hello everyone, welcome back. Patrick here. In this video, we are going to look at Palantir. This is a stock that is in a monstrous decline right now. The stock has absolutely no momentum, and we are back to 2020 prices with a stock under $17. It actually broke one of its main support. So where is the stock going? We are going to address two main concerns in this video. The first one is dilution, and the second one is I'm going to show you, like, using very simple numbers supplied by the company, where the stock is going to go in the next few years, along with potential share prices. So let's get started right now. Hopefully you find this very useful. I know everyone's feeling the pain right now, but when you look at it objectively, I still believe in Palantir, and you probably will too. Alright guys, so currently the share price is under attack, under $17. The last time we saw this was back in May 2021. It may extend and recover to $25 to $28 a couple times. Now, one of the main reasons people use to explain these constant drops is insider selling, which is 100% true, but also dilution. There is this misconception that Palantir is creating hundreds of millions, if not billions of shares, and that's why your shares are almost worthless and the stock is going to go to zero. Now, one of the main articles that people are following, I've seen this reference a few times on YouTube before, is this one from Seeking Alpha and this tweet from Andrew B. Now, he says, biggest issue for Palantir is dilution. Shares outstanding when it went public, 905 million. Shares outstanding as of Q2, 1.89 billion. 100% increase in shares. All right, now, if you see this and you don't really understand the difference between float, shares outstanding, and the fully diluted shares, then you're going to feel like, hey, they're taking us for granted. They're just going to print shares into oblivion, and the company is not going to be worth anything. But that's not really understanding what's going on. When you're talking about dilution, to make it really simple, if you have a company that has 10 shares and they're creating 10 more shares, well then, your 10 shares are not worth as much as they were before. But when we're talking about shares outstanding, like he is right here, he's confusing the two. Let's say you have 10 shares and there are only 2 shares that are being traded right now. But then new shares come into the market, right? So you go from 2 to, let's say, 8, like with Palantir. Well, all of a sudden, these new people that their shares are tradable and they're selling it onto the market, well, that's going to put a lot of selling pressure, because Palantir never made it a secret that for them, going public was a liquidity event. You had all the insiders of the company, the employees, the executives that had shares of the company that they could not actually cash out from. By going public, now they can sell it to other investors, get some money, do whatever they want with it, whether it's invested in something else or actually buy stuff with them, right? So it is a liquidity event for them. There are more shares in circulation than before. It is causing some selling pressure, and that is making the share price go down. But at the same time, the company is not diluting the shares by 100% per year, especially in the future. All right, so you can look at the different filings. It's kind of boring, so I'm not going to go through all of them with you. I just need to absolutely show you the basics so you understand it. So if you look at it, December 31st, 2020, Class A shares outstanding 1.5 billion. And it did go to 1.9 billion by September 30 of 2021. So there is more shares in the market than there was before. But at the same time, Class B shares goes from 249 million to 89 million, right? So there's 2/3 of the Class B shares that are now gone. So over time, shares are converted from the insiders. They're sold onto the market, but then you don't have to worry about them anymore. This is slowing down very rapidly. So if you look at this one, this is really interesting. Alex Carr back in 2009 was afforded, 2009 was 61 million options, and then 2011 was 8 million options. And look at how these expired at the beginning of December 2021. And look at what happened to the stock in the past 2 months, right? It has been massively going down. So there has been a lot of insider selling. Remember when Elon said that he had to pay taxes? So he got a lot of shares, he had to pay taxes, so he dumped a lot of them on the market, and that did have an effect on Tesla. Exactly the same thing is going on with Palantir. It's not them creating new shares, right? A little, like this one with the options, but not billions of new shares in the market. Now, you can look at the executive compensation between now and 2030 if you want to go a little bit deeper into this. I'm just going to sum it up for you. This is a chart by Morgan Stanley when they do their projections. It's just going to explain how this all works. So look at how in 2020, they had 986 million shares, and this, as the guy said in the article from Seeking Alpha, did go to 1.9 billion. So that is a lot more shares in the market, and we have felt that, right? The share price has gone down. But look at 2022 and 2023. This goes up to 2.0, like basically 2 billion and 36 million shares, and then in 2023 it goes up to about 2.1, right? So it is slowing down drastically. And then if you go look at the diluted shares, meaning all the shares of the company, including the ones that are not being traded, this goes from 2.3 billion this year, or 2021 rather, to 2.4 billion in 2022, and also 2.4 billion in 2023. So they predict that it's going to go up about 3% from per year going forward. So not going to double by 100% every year. Now, once you understand this, we can actually go look at actual numbers to figure out what's going on with the price and where it's actually going to go in the next few years. And I feel like this is going to be very reassuring for you. All right, guys, are you ready for some goofy numbers that are going to put a smile on your face? So here it is. Back in June of 2021, the stock was trading at 40.72 price to sales ratio. This has been shrinking since then. December 35.05, then December 12th, it was at 24.65. As the share price drops, the price to sales ratio is going to get lower and lower. You're going to see it in my little model that I built. We're also going to use 30% revenue growth for 2021 through 2025. That's the numbers supplied by the company, and they almost promise us those numbers. They've been really working hard on building their commercial division. We're also going to be using 1.52 billion revenues for 2021. We don't have the fourth quarter results yet, but let's assume it's around there. So when I built this little model here, you're going to see the numbers get high very, very fast. So 2021, 1.52 billion revenues. This could go as high as 4.3 billion in 2025. 30% compounding is very, very quick growth, right? So the numbers are high. The company could generate as much as 3 times more revenues in 2025 than they did in 2021, right? So that's very, very fast growth. Well, you're going to see the stock price actually increase. Alright, so if we use the price to sales ratio of 21.97, which is where it is right now, you're going to see that the current share price, right, was around 17.59. That's kind of what we saw in the past few weeks, right? So it kind of makes sense that share price based on this current price to sales ratio and this revenue. Well, what happens when the actual revenues go up? Well, the share price has to go up too if we follow the same price to sales ratio. So this year could be about 22.87 based on 2 billion revenues. And that would be kind of disappointing, right? A lot of us have bought in the 20s, so we would be breaking even, maybe still red a little bit, and that would not be a great year for us. However, if we go all the way down to 2025, well, then that same price to sales ratio that we have right now would equate to about 50.25 share price, right? So for most of us, that would be a double or a triple. So I know it's not as exciting as me saying, hey, it's going to 10x, but these are very, very realistic numbers. Maybe at that point, the stock was going to be different. Maybe it's going to grow faster, slow down a little bit. Maybe it's going to be based on PE ratio rather than price to sales ratio. We don't know quite yet. These are the numbers that we have. And to me, $50 by 2025 is very realistic. Now, let's use a best case scenario and a worst case scenario. Like if everything goes to shit, what happens? Well, if everything is very euphoric at 35 price to sales ratio, keep in mind this happened before, right? That's where it was in June. That's where it was in September, right? Happened multiple times in the past. The stock went crazy and went high, right? So here I had $28, and if you notice, we actually reached that before. So it's not impossible whatsoever. Well, at 35 price to sales ratio, this year could actually end at $36. Then 2023, 47, 61, and then 2025, we could go as high as $80, which would be a 4x for most of us. Now, what happens if worst case scenario, it goes even lower, right? Currently, we see like that multiple compression. Well, what if it goes to 15 instead of where it is right now at 22, right? Well, that's when the numbers get pretty bad, but again, not catastrophic. Time is on your is in your favor. So the fair market value, like the real value of the stock with a 15 price sales ratio, would be around like 1630 in 2022 based on a $2 billion valuation. All right, so again, like we wouldn't be having a very good year. But again, that's why like the market's not necessarily about just always timing. It's also the time that you're in the market. By 2025, worst case scenario, we would be at 35.80. So everyone that's bought into the stock so far pretty much would be profitable at that point. For me, it would be a double. Now, a double in 4 years, it's not really sexy, but yes, I'll take it at this point, right? The stock has no momentum. When you look at the worst case scenario and it's a double in 4 years, can you really complain about it that much? And I know it feels terrible right now, but you have to look at it objectively. You guys can actually do the same model if you want. Like, let me know in the comments if you get different results, if you think that my assumptions are wrong. But again, I'm showing you like 15 and 35, the two extremes, and the current price to sales ratio. So let me know what you guys think. I hope it actually helps you understand a little bit more about Palantir. I'm still bullish about the company, even though right now I'm feeling the pain, but I'm going to stick with it. I think it has a pretty bright future, and I'm very, very encouraged with their growth in the commercial space. I'll see you guys in the next video.